Have you ever wondered about those small percentages that seem to quietly reduce your investment returns, making you question where your money is actually going? Investment funds have expense ratios primarily because managing a fund involves significant operational costs. This ratio represents the annual fee investors pay to cover these expenses, allowing the fund to function and manage assets professionally on their behalf. The core mechanism behind expense ratios is simple economics. Funds employ a team of financial professionals, including portfolio managers, analysts, and traders, who research and select investments. Beyond personnel, there are administrative costs like legal fees, accounting services, regulatory compliance, marketing, and record-keeping for every investor. These ongoing expenses are pooled and then distributed proportionally among all fund investors through the expense ratio, ensuring the fund can continue its operations. To evaluate an expense ratio, always look for the figure presented as a percentage of your total investment. For instance, a ratio of 0.50% means you pay $5 annually for every $1,000 invested. While a lower expense ratio is generally better for your long-term returns, it is also important to consider the fund's performance before and after these fees, its investment strategy, and the quality of its management. You can easily find this information in the fund's prospectus or on financial websites. A key insight here is the difference between actively managed and passively managed funds. Actively managed funds, where a manager makes strategic buy and sell decisions, typically have higher expense ratios due to the intensive research and decision-making involved. Passively managed funds, such as index funds, which simply aim to track a market benchmark, usually have much lower expense ratios because they requiring less active management. Understanding this distinction can significantly impact your net returns over time. Ultimately, expense ratios are a necessary cost of doing business in the investment world, but being mindful of them can greatly enhance your wealth-building journey. By understanding what these fees cover and how they differ between fund types, you are better equipped to choose investments that align with your financial goals, ensuring more of your hard-earned money stays invested and grows for your future.